Sounds good. I hope everybody can hear me. My name is Mariia Eroshin. I know it's spelled using two I's, but it's pronounced normally as Mariia for those who are thinking about that. I have the pleasure of moderating and introducing our panel today. I am a managing director of Family Office Foundations and Endowments at Certuity. We are a multifamily office. So we are an allocator to many different asset classes on behalf of our families and provide various family office services and essentially help run family offices for our families. And we do look quite a lot at alternative investments and private credit, alternative credit in particular. As my second kind of sub-career, I guess, I have also been an adjunct faculty at university and have been teaching alternative investments for over 15 years. And I have served various roles in family offices, from head of investments to CFO to various types of roles for a family of wealth as well as foundations. Well, I have the pleasure of introducing my panel, and maybe we'll just go in the order everybody appears on the screen. So I see Suzanne first. So maybe Suzanne, if you start introducing yourself, that would be
great. I think there are people talking in the background. I don't know.
Yeah, John Cataldi, I'm trying to mute you for some reason. It's not working. John, if you could mute yourself, that'd be great. Thanks.
Do you want me to mute me?
Suzanne?
Murray. Okay, well, I'll introduce myself. I have a family office myself. I was a partner to hedge funds that we sold to Carlyle back in 2010. And I'm also very focused on the alternative credit space.
Okay, and Bill Timmerman?
Bill?
Thank you, Marty. I had to unmute. I'm Bill Timmerman. I'm a managing director at Xnergy Financial. We're a generalist investment bank, a boutique investment bank. We deal in purchases, sales of companies, raising capital for companies, and the like. So very much generalist and been in this business for many years.
And
I
Jack?
deal with family offices quite a bit, by the way.
Okay.
Jack, you're on mute.
No, Cataldi's not speaking. It's
Okay.
just you two.
Okay, great. Okay. All right. Well, we usually look at quite a variety of factors when we evaluate private credit. And of course, with anything credit, one of the key topics that comes, with talking about this is interest rates. And we have seen quite significant changes in interest rates, and just wanted to see what the panel is thinking about that, how that affects their strategy, and what the outlook that they have for this asset class for the future, given the rate environment that we're in today.
Suzanne, you're on mute.
Sorry, I'm on mute. I said I'm happy to start. I mean, look, we've been waiting for a decade for rates to go back up, to slow down inflation. In our opinion, there's been much too much, we've added too much to the system. So we think there's going to be problems for companies, which we think we're going to be able to hopefully work out. So it's not going to be pretty, but we don't think rates are going down for the foreseeable future.
Hmm.
And if they do, we think there's a much bigger problem.
That's quite a surprise.
Thank you, Ben.
Suzanne.
Sorry, I'm leaning in to listen to who's.
Oh, this is Bill, the investment banker.
Oh,
I was just going to say, Suzanne, that's quite a surprise, given that the current view, if you will, is that rates will decline somewhat during 2024, 2025, and hopefully end up with a, quote, soft landing.
well, that's because there's an election cycle, and you've got a Democratic president who is trying to fix his situation. But I don't think the Fed is gonna listen.
That there is a lot of underlying inflation still there. Yes, that they've grown the deficit hugely, yes. Both that would mitigate, but the rate curve still indicates a decline.
But we've got, I mean, this is a very complicated conversation actually, because
Yeah, it is, sorry.
if you, no, but I mean, if you think about, I mean, maybe it's a very relevant conversation, but you think about the inversion of the rate curve. I mean, I just bought a new car. Last thing I wanted to do was buy a new car. It was cheaper for me to buy a new car. Explain that to me.
I might mention that we have seen most of our clients believe there's going to be a slight decline in rates. We haven't seen anybody shying away from refinancing or buying property. In fact, we have one guy who's come to us to buy some convenience stores that he operates in California, of all places. So there are people still quite bullish on that. We have seen in the healthcare space, we have a private client who's on an acquisition binge, selling some properties to buy some more. So not a shying away from it. We've also seen some earlier stage companies hoping the rates will go down, of course, for the early stage, but but running into quite a bit of difficulty because of the unknownness and the early stageness. So they kind of play yes and no to what you're saying. A long answer.
I just think it's a very complicated time. And I, think that we all need to be aware of the fact that there's opportunity, but caution.
Yeah, and actually that is a good segue to the next question is we think about private credit, there's opportunities in the rates, and maybe I'd be curious to see what kind of returns you are seeing and for what type of strategies, but also what types of risks you are seeing, especially as we head into kind of this economic cycle, and where are we at, especially as it relates to the books that are existing loan books in private credit, as well as kind of the build out of the new books.
Go to it, Suzanne. You made a good start.
Come on, why do I always have to go first?
Because I love your
So
opinions.
not
I can
fair.
count.
So I do think this is actually a very good vintage for private credit. I think private credit that's going to be issued today, underwritten properly, right? So you have to pick your managers. There's going to be a lot of good stuff to do because the regional banks are crippled. That's where these smaller companies used to go. And so you need help. Now, we're raising a new fund. So to do what my partners used to do years ago in the lower middle market restructuring space, right? You've got a bad balance sheet, you've got a good business, you've got good management. We want to help you fix it. So that should help us too, because we should be able to show up and turn that into a positive situation. But I do think it's a very difficult time. So you need a good company, a good business, a good management. If your balance sheet's bad, people that do what we do are going to be able to step in. The regional banks are crippled. I don't know, Bill, you jump in here because you forced me into the conversation.
No, unfortunately, I agree with what you're saying. So I have nothing to really add. We have seen, we haven't run across the guy who's suffering yet and needs to be restructured. We do have a few. Yet. I have noted, though, I have your name on file here. When they show up, I'll give you a ring. we have had people coming to market. We have, as I mentioned, some decent companies. And I think if the decent companies are coming to market, they still find a welcome at the BDCs if they have the right partners. I think those people are open for business pretty much. I think some of the large banks are open for business. And I think, yes, the regional banks are not going to be much use. So our first idea is to go to alternative sources of credit rather than the banks. Even though it's a little more expensive, it's probably a surer and a faster close. And that's where we're taking some of our people, even though it's not the cheapest source of money. It gets the deal done.
Yeah, and I would probably,
Maria, is this a reporting question? So, you know,
yeah, I was actually about to add to the discussion too. So things that we kind of look at when we are evaluating, we're very careful in private credit space on behalf of our clients, but things that we look at is, and this is kind of very similar to what Suzanne was also referring to, is we look at a number of factors, and one of them is it a very diversified book of loans? What is the longevity of those loans? What's the duration? So are we talking about something that's very, very short term and it's a new replenishment of capital? Are we looking at a very kind of an old stale book? We're also looking at leverage at the fund level and kind of the leverage that each company is taking. We're looking at various types of industries and industry subsectors of private credit. So examples could be middle market. Comprises quite a lot of private credit. And then could be a difference between a private credit manager have 20 loans versus somebody who's got 300 some loans. So for diversification purposes. We also look at quite a variety of factors on the actual credit quality and underwriting and how the manager is doing that, at their history, as far as, kind of the default rates. This is not yet, right, Bill? I mean, it's kind of in seeing what has happened in the subsector and what is the collateral. Thinking very carefully, is it company assets? Is it real estate? What are the variety of different collaterals that could be in the private credit? So there's quite a number of strategies that range literally when we evaluated anywhere from a 1 month duration, so literally very, very short-term private credit facilities to, with guarantees and backed by, incoming collateral, all the way to kind of a little bit more of a couple of year step of private credit. So, but curious to see what factors you see and evaluate as you look at the deals. I mean, this is kind of not all, but some of the things that we look at, and just thinking about what are the factors that you see and how do you evaluate private credit opportunities in this environment? And Bill, maybe today you start.
Well, we don't evaluate. Our main criteria is, do we have a place, do we know investors who might buy that credit? So actually, when we're looking at this, to sell it, we look at almost the same factors you're looking at, and we look very much at leverage. We try to take a look at what the market's doing for leverage. How does this compare? Have they been growing? Do they throw up extra cash flow or not? What are their minimum capital expenditures they need? What sort of assets do they have? Do they have backers or not have backers? It's the same questions, because we try to put ourselves in the investor's point of view, because these are the people to whom we're trying to sell the credit. So we'll do much of the same analysis. In fact, having been a banker and being an investor many years ago, I've been there, done that. So we look through the same lens, and I think we've been pretty successful. That's why we've been successful, because we have that same lens as the investor. So same things you're looking at.
Yeah, Suzanne, what about yourself?
I can't disagree with anything that Bill has just said. The direct lending business is a little bit different than what we try to do. Look, I come at this from different ways, right? I have a family office. I do a lot of personal investing. I get 40K ones a year. But the firm that I work with, we're looking to invest through the public capital stack. And I think that there is a situation right now where there are haves and have-nots. And there are good companies with bad balance sheets that aren't able to get financing that can be worked out. And that's where we're trying to be focused. So, you know, there's tremendous, I mean, by the way, there's a lot of bad ones. Don't get me wrong, but there are really good opportunities that I think people are not focused on.
In the public
And maybe
sector.
to,
I'm sorry to interrupt there, Mary. I'm just saying,
go ahead.
Suzanne, in the public
oh,
sector? You
Yeah.
said these, all in the public sector, okay. And
We
medium-sized
focus on public debt, tradable debt, CUSIP securities.
And actually, a follow-up question to both of you as to, you both mentioned the kind of a working out process. How important is it in your decision-making that whoever the, you know, provider of credit is, has a skill set of working out that type of collateral if in the, you know, in the case of any kind of going south of this situation?
Frankly,
I'm confused about your question about the provider of credit, because I would effectively think that I'm the provider of credit.
you would be, yes, that's how I looked at it. You would be, so if, quite frankly, on this type of thing, we try to, those type of risks, we haven't come across yet. When we come across that, we want somebody, we would not be able to sell this to anybody except to someone who absolutely had gone through this many times. So the expertise, but if we have at least a B, even a B credit, we don't even want to think of restructuring. And we try to look at selling it to someone who's going to hold on to it.
Well, Bill, you and I need to get to know each other better, because maybe there's some things we can do
Well,
together.
you're in the public space, we're in the private space.
I understand, but there's a lot of synergy. You know, we like to enter through the public credit, figure out what we think is the fulcrum security, and then work with management to help them fix their problems.
And actually, that might be helpful for our audience to kind of hear a little bit, because a lot of private credit depends on the type of collateral that we're actually discussing. So maybe you can each address kind of your side of the collateral. I know, Suzanne, you already spoke about the public side of the credit, and Bill, maybe you could speak about where are you focused? I mean, is this, you know, where in the middle market? Is it what kind of EBITDA, or where in the marketplace are you focused as far as providing credit?
Again, we don't provide, we're being intermediaries. We focus on the lower middle market. So we try to get 2 million of people who have 2 million of EBITDA up to maybe 20 million of EBITDA is typically where we are. And in getting credit on this, one of the key things is what sort of security do they have and how much loan to value do we think we can get on it? And how, and what sort of other covenants will be around to limit, either reduce the loan to value or screw up the deal in one way or another, especially if they're lending on real estate and someone else is lending on a business part. And other creditors coming in can be a royal problem, especially if they have other liens. So there's quite a bit, you cannot go into the space even to offer it to other investors without looking very carefully at who are the other lenders, what's their track record, where are they in there? Is anybody close to default? Where are they on the ratios? If we see there's a default coming, an investor's got to see it. And so we have to have answers to that question beforehand. So I'm not sure that answered the question though.
Yeah, that's very helpful. And Suzanne, maybe you can talk a little bit about the public side of the credit, because that's an interesting, you know, difference in space between you and Bill.
Yeah, I mean, look, we're not doing direct lending. So we look to find what we think is the fulcrum security of a business that is impaired. And oftentimes, frankly, they're impaired by their private equity sponsors, right? Because they've been levered up, dividended out. I mean, I hate to say it, but it's true. You know, they've been levered up and dividended out because the private equity guys want to give the money back to their investors. And so you've got really good managers of businesses that say, gosh, I'm over levered. I didn't need this leverage in the first place. I need to get fixed. And, when money was free, it was different. And now money's not free.
And you have more covenants in any new loan.
Well, hopefully, yes, that's the goal. But, nobody wanted to talk to us for the last 10 years, which is why we stayed out of the market, which is why we're raising a new fund now. We stepped away.
Good timing.
And maybe
not
to-
so easy to raise money, but we did honorably say, okay, money's free, nobody cares, let's not do this. Now it's different.
And maybe both of you can share what is, as much as you are able, as to what expectations you have as to returns, either in kind of in the actual strategy or, specific kind of deals that you see. What do you see as far as projected returns?
You, Suzanne, you're investing.
Why does he always make me go first? Aren't girls
Women
allowed
first.
to, come on. No, but I'm happy to take it. We think high to mid double digits.
Yeah. Wait a minute. High to mid? That's mid to high.
15 to 20.
Okay, there we go. Yeah.
You want a specific?
No, that's what I expected. At
Bill
least
is
that.
tough, this guy. I gotta be really specific
no-
with him.
Well, yeah, but I would have expected actually for what you're doing, you'd be more like 18 to 25. But I like
Well,
your
we
15.
underwrite to that, but I'm not gonna tell you net of fees.
Yeah, I would think, because for credits, even today going out, by the time you add a spread, people are minimum 10%. If they
No,
get any,
no, we're not doing this for that.
no, but no, that you're a higher risk area. I'm talking about the lowest risk guys. If they're at 10%, you've got to be. That's why I say 20%. You've got to be double that to protect
I
your
tell my
margin.
stepmother, if you make 5% a year, you should be happy. Don't talk to me. Don't call me.
I won't.
No, but she got all my father's, it's like, whatever, 5% a year is fine.
Yeah, no, but
But
we
what we do is much riskier.
Much
and we
riskier.
underwrite to 35 to 40%.
Yeah, so we typically think the old classic is mezz debt is somewhere around 15 to 18% for lower middle market. You're a risk beyond mezz debt, and therefore you're.
But
probably,
we don't use any leverage, by the way.
Oh, okay. So that's even more fair. If I took a BDC doing a unitranche loan, they're probably at 12%. So you're right
Correct.
where you should be.
And they're levering it up.
Yes.
And Bill, what about yourself? Are you using leverage? And what are both of your feelings on leverage? I could probably sense what Suzanne is going to answer to that, but what are your thoughts on leverage?
Well, what we right now for somebody with, if somebody only has 2 million of EBITDA, if they can get 2 times, I think I'd be delighted. If they have 20 million of EBITDA, we probably get the 3, maybe 4 times if we're really lucky. With some of the BDCs, if we have a good sponsor behind them. But I don't think we would stretch for anything beyond that. The days of 5 and 6 and 7 for the lower middle market aren't there. Upper middle market, yes, maybe, but we don't play there.
I think what we view is we don't use leverage because we feel like the businesses that we're investing in are already too leveraged. I think Bill's in a slightly different space.
Mm-hmm.
So we basically are like, you're already levered enough. We're going to shore you up. We don't like leverage. We feel like the business we're investing in is already leveraged enough.
And we probably out of the spec, we were kind of more in the spectrum of preserving capital. So we do look at a little bit more conservative strategies. I mean, we look at the full spectrum, but some of our more conservative strategies are, 1 to 3 months, no leverage. I mean, and they're still producing pretty solid returns, at least currently, but we also have very diversified strategies where over 300 loans and, so we kind of look at a little bit more, very careful on leverage, very careful on duration, so we kind of are probably the more conservative space. We're in the, at least in the middle market. But we have looked at venture debt as well. We've looked at a variety of different strategies, and we continue to evaluate more and more new strategies over time. But, kind of there's a whole spectrum in private credit. Marty.
You guys are all dependent on rates. Where do you see rates? The Fed positioning, it seems to be dovish right now. Where do you see rates going, and what's the impact on the credit markets? I mean,
Yes.
I think Suzanne said banks are pulling back or have pulled back.
I don't, Marty, I mean, it's hard to hear you. I do
Yeah,
not.
Maybe, let me repeat the question. So Marty is asking to see what our outlook is on rates and what the Federal Reserve is going to do.
So listen, I don't want to be a pontificator on rates because the government is whatever it is. But I think it would be very hard for them to lower rates. Inflation has not shown any pullback. So they might, because we're coming into an election cycle and Joe Biden wants to get reelected, but I don't think it would be good.
You've added a moral aspect, Suzanne. Now that's not fair. You can't
Wait,
add
who said a moral? Is that Bill?
Well, you said that would not be
There's
good.
no moral
Good,
aspect.
good or
It's
bad
not
is a
getting elected. Come on.
yeah. Well, if you have the rates, people have said the market is saying the rates are going to slowly go down, and I wouldn't have an opinion against the market. So with the slow going down, 1% less for next year, I could buy. I think that's what we see in general. Now, those are general opinions, and general opinions, as you know, are wrong most of the time.
Look, my father was born in 1933. Maybe I'm a child of the Depression. I don't know. I mean, I'm not a child of the Depression, but was raised by a child of the Depression. I think we need to have a much more difficult stance.
Personally, I agree with you. Yes. I don't think I think they're going to lower the rates, but I think it's wrong. I think they should stay this for another. I agree with you 100% on the personal level, but on a business level, if I had to make a business judgment.
No, I agree with you because of the election, Biden's going to do what he needs to do. But it's wrong for the rest of our lives.
Thank you,
It's a
grandkids.
policy issue. From a policy point of view.
I have an 11-year-old child. She's going to have to survive with what is done today. So yes, I agree. He will make a bad decision and it stinks.
100%.
We have a question in the back, and I'm going to speak up, but maybe we'll see. Use your strong voice.
With respect to a lot of these large equity groups, they've done so well doing equity, but then what's their attraction of getting into lower yielding alternative credit?
So the question is, for the equity groups that have done pretty well in the equity spectrum, what is the attraction of getting into the debt side of the equation?
If it's an equity group that's been used to dealing with equity, the way equity looks at something is the future. The equity is not looking to the past. When a debt person always looks to the past as prologue. So you have a radically different mindset between the equity and the debt people. And if you're an equity person and you're now going into the debt space, you're going to a space you probably know little about. And good luck.
You know what? That's a really great way of putting it. And I will tell you that, you know, where I made my own wealth was in a long short credit hedge fund. And we were really good credit pickers. And people used to say, well, you're such good credit pickers. You should do a long short equity fund. And the difference is, if you're a good credit person, you are a glass half empty person. If you are a good equity person, you are a glass half full person. And those two things don't,
Yes.
they do
Unless you're an
not,
equity short.
well, that depends though. Equity shorts are way more expensive than credit shorts. But the point is, it's a different mindset, which was to Bill's point, that credit people are glass half empty, equity people are glass half full.
Do we
Don't
have any
mix
more
up.
questions from the audience? All right, well,
Yeah, sure. So a lot of people are talking about private credit and, you know, the importance and how it's gonna do great with banks pulling back. But so far, I think Bill already said that he's not seeing the distress emerge yet. Is that because there's a lot of distressed funds out there already who things might be happening behind closed doors that we don't find out about?
so I'll just repeat the question to make sure everybody heard it. So Marty's asking, you know, given that Bill mentioned that we haven't really seen the defaults and even kind of the banking system, everybody's talking about the importance of private credit, but maybe there's already quite a number of distressed funds or other available distressed funding opportunities where we haven't seen that reflect on the private credit.
These are
I'm not
private
sure.
deals, and we just need to see more.
Maybe we're not just seeing the private deals.
I think that that's like a really compound question. So I want to try to parse it. I think personally, there is a lot of misconception in the market about how much trouble there really is. You know, I think there's a Pollyannish view. I think managements have it. I think creditors have it. I think it's going to be uglier than we think it's going to be. There's going to be winners and losers, but I think there are going to be losers. So, you know, we forget that so much of what's been issued in the last decade is floating rate. You know, when the banks start to move the numbers, these companies are not going to have a great time.
Speaking actually of floating
I'm very
versus.
sorry, and Bill's nodding his head, but you know,
Nothing to add.
I'm a negative Nelly, but I try to be a realist.
Yeah, it shows you were in credit.
And speaking actually, that is also a very good follow-up question.
Well,
as
my
to
father
your
was an
view on-
equity trader, though, Bill, in all fairness, so I've been on both sides.
So thinking about the floating versus fixed in the credit spectrum, that's also something that is an interesting follow-up question, but I'll let you, Bill, kind of chime in on Marty's question as well.
I mean, Suzanne, she said everything. What can I add?
Well, then tell us if you look at fixed or floating on what you're seeing in the private credit.
We rarely, well, we've seen people with who'll try to swap things, but I think most of what we've seen is floating. And I think there's almost everything is done at a lot of stuff. So much stuff is done at floating that if they want to have a fixed rate, they swap it out.
Got it. Suzanne, what about yourself?
I think it depends. I think Bill's coming from more of a private credit perspective. So, you know, again, we look at the public stuff, which we want to work out, but I think we're coming from the same place. It's not a pretty scenario. And I think if people are going to delusionize. It's not a really word, is that delusionize? Be delusional. Be
No, delusionize is
delusional.
much better. Keep it, keep it.
Okay, well,
Be
we invented a good
delusional
word on the
about
panel.
where we are. It's not good. And again, I'm a credit person, so I come from the glass half empty. I'm not an equity person, but I just think we're in for a tough haul.
Do any of the persons, do they think that there's gonna be something critical that will happen that could set off the credit market?
Do you think that there's going to be some sort of critical event that might happen that would set off the markets?
I think if they don't if the Fed
It's
by
like a
March
million
or if the Fed by March or April doesn't lower the rates a little bit, I think people will suddenly become a little more skittish. That's my personal view. I think there's such an expectation that rates should go down by little quarter increments that if they don't, people are going to have to stop and look around again.
So, Bill, let me ask you to be a little controversial here.
Oh no!
As a child of the 1970s, rates were really high. Mortgages were 17%.
Oh yeah.
Like, why shouldn't the world get religion now?
So far, we've been playing the greater, as long as we've gotten people to buy these bonds at this rate, don't shake up the roost. But gee, golly whiz, if they start not being able to roll over something, whoops.
But you said rates should come down.
I know. I said the general market expectation is that rates are coming down. I said personally,
But you think that's what's good for the world?
You're asking me to make a moral judgment, which I certainly.
No, it's not a moral. No. It's a financial judgment. Has nothing to do with morality.
It has.
Is it possible that some of the credit
I love the judgment.
Some of the bad credit we're not seeing is because this is a revolver that's opted for banks to use? Is that covering some of this up?
So,
Bank revolver that
Marty, is Andy,
I'm having trouble hearing Marty.
Yeah.
yeah, Marty is asking if there are some bank revolvers that we're not seeing, and
that are being used.
that are being used.
That are covering up distress.
that are essentially, then we're not seeing distressed because there are those revolvers in place.
To the extent they have excess money available under the revolver and they're meeting the covenants, then they're still not distressed. If they're against their covenants and they cannot borrow anymore and they're running out of cash, even though they have availability, but they can't draw, that's a little problem.
I know we have a
think
question from
there's
Maureen.
Sorry, go ahead.
No, go ahead, Suzanne. Why don't you add to this question? Because we have another question from the audience right after.
No, I think there's obfuscation by the banks. I do.
Right, when Silicon Valley Bank went under,
That's my question.
they opened up a revolver for all the other surviving banks, right? And they've all been using it far more than expected.
Yeah. So my question really goes to, after 2008, basically we just kicked the can down the alley for years and we just kept the rates really low. Now I'm looking at all this pain in the real estate market. I'm looking at lots of construction loans, developers out there. And you're looking at a lot of banks kind of twisting their fingers here. And I'm like, I don't think we can lower rates to the point where it's going to solve the problem. And so when does the shoe drop? And what other techniques do you think could happen either from a political policy perspective, because the Fed's hands may be tied? I'm worried about it. I'm very concerned about it. And the implication it's going to have, just because I've looked at some of the stats on commercial real estate and I would be really interested in your perspective, because I felt that looking at what happened in, buyouts in like 05, 06, 07, they got out of it because rates were so low for such a long time.
Maybe a way to restate it is that, is there a contagion in
We-
real estate that gets into the other markets?
Yeah.
Can you say that?
Is there
Sorry,
a
I can't
contagion
hear
in
you,
real
Marty.
estate? So is there a contagion in real estate that could potentially have an adverse effect on other markets?
1,000,000%. I mean, I think that, and I'll take a very strong stand here, but, look, I live in New York City and there are so many vacancies, so many lack of tenants, such an inability to sell apartments. I think it's gonna reverberate for quite some time. And I think anybody who thinks it's not is delusional.
Bill, what are your thoughts on that?
There's a lot of stuff out there. And I think you could add the real estate. And I think if there is no, I think there's so much of optimism built in to rates going down. I do think if rates stay the same, I think people will reevaluate, and then I think that will panic them, and that will compound anything happening in real estate. So the very fact they
Bill,
don't-
I don't think rates are gonna change real estate. I think people are not going back to the office the same way they did.
Oh,
I just think
oh
it's
yeah,
different.
that's for sure. Yeah, absolutely, absolutely. In fact, I'm surprised there are that many people in the office. I mean, half the private equity people or even venture capital people there.
Commercial real estate is never gonna go back to what it was.
Agreed. Oh yeah.
Okay, well, do we have any more questions from the audience? I think hearing none, maybe everybody can make a couple of, like a minute of a wrap up and we go from there. So I don't know if maybe Bill will let you start this time.
A wrap up.
Yeah, a couple of closing comments, whatever you'd like to mention.
Well, I'll take Suzanne's glass half full and say that I think it's better to look at your glass half full, plan for it to maybe get 40%, 45% full, rather than think you're going to be filling it up to 50 or 55 or 60%. And if you have that attitude with any credits you're coming across, you're going to be far better off than if you take that nice optimistic view, and that it will get better. It'll probably get worse first.
Suzanne, any comments?
Bill, you've been very gracious with your comments about my, little bit of knowledge about what goes on in the world. But, I'm not optimistic momentarily. I think you have to be optimistic for the long term, and Warren Buffett and smarter people than me have said, if you just sit with what you're doing and you can have the perseverance to do nothing, you're better off. But that's not human nature. I think there's going to be a lot of opportunity in distressed credit.
And just to
and-
wrap up, I mean, I thank everybody on the panel. I know Marty's sitting next to me, so about to open up the next panel. So I know we're right on time. I'm glad to connect with anybody on the family office topics in general or private credit, and I'm sure our panelists are glad to continue conversation with folks here as well. So thank you, everybody.
Great job.
Thank you.
Thank you.
I've known Mariia for many years, and Maria's a Wharton person as well. And you are basically the head of family offices for
Yes.
your RA that you work for? Perfect, great.
So, yeah, I run our practice of the family offices, foundations and endowments. I'm a managing director. And yeah, we're firm of, like, we have an office here in San Francisco. I'm local to here, but we also have offices in New York, Florida, and Los Angeles. So it's kind of a broader firm, but we're a multifamily office and really happy to serve families in a variety of different ways. And we do quite a bit of private credit and evaluate a lot of strategies. So I'm really glad to contribute to this panel.
Fantastic, right. And just to get back to what Bill Timmerman said, March or April, if the Fed doesn't act, people will start getting skittish. So maybe that'll be true. Love to get Arun's point of view, because I know he's more on the Suzanne Murphy point of view. But I think that the issue is, what Ed Yardani says, it just seems that when things look bad, the Fed has this infinite bag of tricks to kind of put things up, right? So